welcome in. It's Michael Murray with Benzinga here today, being joined by Rob Hocking, the SVP, Global Head of Product Innovation at Cboe Global Markets. Always great to be able to talk with their team. And today we get to do a deep dive into volatility. Rob, really excited to be talking with you. How are you?
I'm wonderful. Thanks, Michael. Thanks for having me today.
Always a pleasure to talk with you and the team and to get more product definitions and product explanations and more of the explanations that we need for what Cboe Global Markets does and how they work with retail traders. So excited to dive into this and talk about volatility today. What is implied volatility? How is it calculated? And then more importantly, what's the difference between implied volatility and historical or realized volatility? Can you start us there?
Sure. Yeah, a lot of good questions there. Implied volatility is just a statistical measure of how much a security is expected to move over a future period of time. So in simple terms, you can think of it as the market's forecast for how much a security's price is going to move. Now, what's really important to note in that is that implied volatility it's based on probability. So it's an estimate of generalized price movement. It does not predict direction. And I always think it's important to even repeat that. It does not predict direction. How is it calculated? So implied volatility can be determined by using an options pricing model. One of the most widely known is the Black-Scholes model. In the Black-Scholes model, it considers 6 different inputs into an options price. 5 of which of these inputs are directly observable. Things like underlying price, strike price of the option, time to maturity, risk-free interest rates, dividends, with the only unknown input being implied volatility. Therefore, if you treat the 5 directly observable inputs as constants, you can back out from an options price what the market's implied volatility or expected volatility is. You also mentioned, there's a lot packed into this question. You mentioned what's realized. And I guess the big thing is, what's the difference between implied versus realized? Implied volatility is a forward-looking measure. It's a guess on how volatile a particular underlying will be. It's an estimate. It's an unknown. Historical or realized volatility, well, that's backward looking. And that is a measure of how much a particular security did move over a past period of time. So it's known. It's a fact. There's nothing to debate about it. That's really the biggest input. Is one forward looking, one's backward looking.
Terrific. Okay, great start. And let's talk a little bit more about the implied volatility side of things. How does implied volatility affect the value of a call option versus a put option? What's the distinction there?
Sure. As I mentioned, implied volatility is based on probability. So I think the best way to illustrate how implied vol impacts options pricing is to think about it in terms of a distribution of returns. So take a bell curve, for example. In a low volatility environment, the distribution will have a very narrow shape. It'll look like a steep peak with very little to no tail. In a high volatility environment, you have a much fatter distribution. So think of fatter tails, flatter distribution, because the probability of returns falling in those tails is now greater when there's higher volatility. So therefore, when you're looking at pricing of a call or a put, it affects the call and the put on the same strike identically. If implied volatility increased, so does the option's value, because the probability of larger moves happening has now increased. Thus, it's worth paying more for an option because it now has a greater probability of finishing in the money. Or more simply put, with higher implied vol, there's more optionality in your option.
Terrific. Okay, now let's talk a little bit about the VIX, what many people call the fear indicator. Can you talk to us about the VIX, what exactly it is, how it's calculated, and the role it plays in the options market, and how can traders use it?
Sure, absolutely. So the VIX Index measures the expected volatility of the S&P 500 over the next 30 days. And so now I'm a visual learner, so maybe it would help to think of it as a chart of, SPX returns. And think of an image, and everything that has happened prior to today, as we discussed, is historical or realized returns. The volatility that is forward-looking is the VIX. So the VIX is looking at this forward-looking measure of what's expected or what implied volatility will be over the next 30 days. So yet to have happened 30 days. So how is this calculated? The VIX Index is calculated using the midpoint of real-time S&P 500 index or SPX option prices. Now, during the day, the VIX values are based on snapshots of SPX option bid-ask quotes. They're taken every 15 seconds and are intended to provide an indication of that fair market price of expected volatility 30 days into the future. Like I said, future forward looking. So it takes a look at options that are between 23 to call it 37 days to expiration and backs out a weighted implied 30-day volatility number. So because of this, investors use the VIX to better understand what sort of expected move the market is pricing in over the next 30 days. And so if we're even to take that a step further, in the case of VIX futures, not just the index itself, which is not tradable, but VIX futures, you introduce a tradable fixed point in time for the future estimate. So let's look at an example. So if you look at the March future, which expires on March 22nd, that represents what 30-day forward implied vol will be on that day. So it's actually estimating what implied volatility will be in April on March 22nd. Now, to start, you mentioned, the VIX being linked to, let's call it a fear gauge. And I think the better question might be, why does implied volatility get linked to investor sentiment? As discussed, the VIX measures this implied volatility of S&P 500 over the next 30 days. So it doesn't look at market direction, but merely what is the estimated range the market will have over the next 30 days. A high number, the market is implying a bigger range. Low number, tighter range. And I think it gets linked to investor sentiment because it tends to have an inverse relationship with the underlying S&P 500 index. So the VIX tends to increase when markets are turbulent or the economy is faltering, or fall or remain steady, let's call it at the low end of the range, when stock prices are rising and sentiment is fairly positive.
Outstanding. Okay, a final question as we close out here then. What role does the volatility play in short-dated options? Can you give us that perspective really quickly?
Yeah, sure. So the time component, better known as theta, always increases as the implied volatility of an option increases. You can think of it like higher implied volatility makes options more expensive, since there is a greater likelihood of hitting the strike price at some point. Therefore, highly volatile stocks have higher theta because the time value premium or optionality of these options is high, and therefore they have more to lose each day as they decay and get closer to expiration. At the more macro level, high implied volatility, estimates greater market movement, or as I mentioned, wider possible distribution of returns. Therefore, in short-dated options trading, higher implied volatility equates to, call it, a higher probability that a particular option will finish in the money, which, depending on current market conditions, could impact investors' willingness to utilize short-term options in their portfolio. So really kind of two different aspects there.
Amazing. And as always, the information we get from you guys doing these product reviews, deep diving into volatility today is the topic. Always great to get this out in front of our audience to understand more about Cboe Global Markets and what you're doing. Rob Hocking, SVP, Global Head of Product Innovation at Cboe. We know you had some severe weather to fight through today, getting through to us, so we really appreciate you taking the time. Thank you again.
Absolutely. Thank you so much for having me. It was a pleasure.